We are watchful of a potential air pocket in the US economic recovery due to the waning support from weekly unemployment stimulus checks under the CARES Act that expired in July. Our base case expectation, however, is that new fiscal aid will eventually be delivered by the US Congress. Despite the two parties' disagreements in many areas, both the Republicans and Democrats agree that unemployment benefits need to be extended. Despite the risk of near-term market turbulence, particularly ahead of the US presidential election, we believe the long-term trajectory for risk assets remain positive as it is underpinned by a long-term economic recovery and supportive policy stance. Importantly, we expect the Fed's major shift towards average inflation targeting last week to result in the Fed funds rate staying at current near zero levels for up to 5 years and also to usher in moderately higher inflation. This suggests to us that the uptrend in inflation expectations from their lows in March has more to go, and therefore gold remains a relevant inflation hedge in portfolios alongside TIPS, also known as Treasury Inflation-Protected Securities, as well as long-dated US Treasuries. In our view, the bigger investment implication of rising inflation relates to the equity allocation in portfolios. Over the long term, we believe that maintaining core positions in growth sectors such as technology form an indispensable mainstay of investment return as they provide exposure to key structural trends such as the 5G revolution and the rise of e-commerce, the IoT, and the cloud. Given the dramatic year-to-date outperformance of growth equity sectors versus cyclicals and value segments such as energy, commodities, and industrials, we believe it is an opportune time to rebalance from now much larger positions in growth equities due to the sharp year-to-date rally into selective cyclical and value names which remain attractively priced and are poised to benefit from rising inflation and a gradual economic recovery ahead. This rebalancing of exposure will help to further diversify portfolios, buttress performance, and contribute to volatility management during periods of turbulence ahead. For more information, please read the latest edition of our monthly investment guide titled After a Historic Rebound.